Welcome to Market Overtime. I'm Oliver Rennick. Today's guest is the economist, professor, author, and now ETF issuer, sometimes colloquially and I would add a bit ironically known as Dr. Doom, given his affable personal nature outside economics. It's Dr. Nouriel Roubini, NYU Stern Professor Emeritus, CEO of Roubini Macro Associates, and Chief Economist at Atlas Capital Team, where last month he launched the USAF ETF, designed to be a sort of financial security blanket for investors concerned about things like stagflation, geopolitical risk, possible currency debasement, and more. A few of the themes we talked about last time when he was here promoting his book, Megathreats. Dr. Roubini is here with us on the Schwab Network again, I think for the fourth or fifth time since our debut many years ago. So Nouriel, it's great to see you again. Thanks for being here.
Such a pleasure being with you today, Oliver.
I'm the Dr. Doom moniker. How do you feel about it? Where are we on the Dr. Doom scale right now, from megathreats to generally thinking about potential growth expectations being better than expected? Where are you at?
Well, I never consider myself as Dr. Doom. I say I'm Dr. Realist. There are always upside and downside risk, and we have to assess them. I would say that for the last year, the economy has been on a gliding path towards a soft landing. And if there is a risk scenario rather than a risk of a hard landing, I think the bigger risk is one of a no landing, where for a number of reasons, growth remains above potential, but because of a resource constraint, inflation also remains above target. So I'm more concerned right now about a no landing scenario than a soft landing scenario or a hard landing scenario. And given a number of the potential Trump policies, I would say we may end up in a no landing.
The status that we're at right now, what in your mind has been the biggest causal force for those better than expected outcomes, the soft or no landing scenario?
Well, growth remained above potential while inflation has fallen, but has not fallen to target, in part because tight monetary policy has anchored inflation expectation, but that should have led to a slowdown of growth. I think, one, we got lucky because three of the negative aggregate supply shocks of COVID that had reduced growth and increased inflation reversed themselves, from global supply chains to China ending the zero COVID policy to the effect on commodity prices of the Russian invasion of Ukraine going away, increases in labor supply. But other things happen as well. We had meaningful fiscal stimulus in the US between the IRA, the CHIPS Act, and the Infrastructure Act. We had a significant increase in migration that increased labor supply, increased growth, and it kept lead on wage inflation. And of course, the AI revolution is very important, has led to a significant increase in capex. So we've been in a situation where growth has remained above potential and inflation has not fallen to target.
We talked about some of these things a few years ago when you published Megathreats. So to kind of zoom out and simplify for a moment, a few of those big long-term time frame subjects like climate change, obviously I assume haven't changed as threats. I wonder about any of the geopolitical or economic ones though. Do those 10 threats still apply, or have any of those major ones been reconsidered?
All these mega threats apply, and I would say that under a Trump administration, on one side you could have policies that lead to higher growth and lower inflation, being pro-business, low tax rates, deregulation, more fossil fuel production, government efficiency. Those are positives, but there are also other potential policies that might be stagflationary. Of course, tariff, protectionism, and maybe a full-scale economic war with China, massive reduction in migration or mass deportation, unfunded tax cuts, and large budget deficit might increase a long rate, trying to weaken the dollar, trying to interfere with the independence of the Fed. So on one side, you have policies that may lead to higher growth and lower inflation. On the other side, there are stagflationary policies that were consistent with my mega threats, will lead to lower growth and higher inflation. Okay. We'll have to see what's going to be the balance between the two.
A few of those specific possibilities I want to dive into in some more detail policy-wise, but to that last point firstly, and to rewind to 22, when we were talking about backdrop of bonds selling off, stocks selling off, a lot of the pressure on the stagflation narrative was particularly imminent. Now that we've seen CPI come down much closer to the Fed's range, are those 70s-like stagflationary outcomes at least reduced in probability at this point, Nouriel?
I don't think they're reduced because some of the mega threats that I discuss in my book are medium-term trends, and under some sets of Trump policies, those stagflationary policies remain. As I pointed out, tariff, migration policy, unfunded tax cuts, large and unsustainable budget deficits, trying to weaken the dollar, trying to reduce the independence of the Fed. If those sets of policy were to be followed, in a world in which, of course, because of geopolitics, there is also fragmentation, deglobalization, reshoring, friendshoring, and other types of things that divide the world, I would say they will still remain in a world where gradually, over time, inflation will go higher and growth could go lower.
To the point about deficits and unfunded tax cuts, have we seen any of the modern monetary theory, the MMT playbook, proven out here to some extent, Nouriel, as we ran up debt to GDP levels to all-time highs outside of World War II, but growth has continued to stay in there, and yields and term premium have been quite contained, as the bond market told us that we can stretch out those ratios pretty far?
Well, what happened was that during COVID, the amount of fiscal and credit easing and stimulus was excessive, and we effectively monetized these deficits. And that combination of excessive monetary, fiscal, and credit easing led to a surge in inflation. You could say that proved that modern monetary theory leads to higher inflation when you monetize fiscal deficits. Since then, fiscal deficits remain, but then the Fed discontinued the quantitative easing, went into quantitative tightening, and sharply increased interest rates as a way of controlling inflation and inflation expectation. But if we had continued with large fiscal deficits and monetizing them, we would end up in a world of high inflation.
We also did, though, break way into the artificial intelligence and this great tech revolution that has basically saved stock market earnings. Is that not to some extent a positive outcome, though, too, of flooding capital markets, flooding the economy with money?
Absolutely so. I do actually believe, and I'm optimistic, that potential growth in the US in the next few years is going to go higher. For some reason, for example, in the last 2 years, in spite of Fed tightening, we have growth over 2.5% when potential was initially estimated at only 1.8. And we've had this significant increase in productivity growth in the US at around 1.7% for the last few years. So I think that the impact of all this technological innovation is going to lead over time potential growth to be higher than 2%. Under some really optimistic scenario, if we adopt this technology fast enough, potential growth by the end of this decade could be actually closer to 3%. But these adjustments to potential growth are not going to occur overnight. They're going to occur over time. But those are certainly bullish for the economy, for growth, and for the stock market.
Care to give me some ranges on what type of outcomes you see, Nouriel, whether in 10-year yields or inflation levels? I've heard a few in some of your recent interviews. Catch me up to speed here. What do you think is possible, say, in the next 12 to 24 months?
Well, I would say in the next 24 months, I feel that overall inflation is going to remain higher than expected because of tariff, because of migration, because of trying to weaken the dollar, because of excessive deficits. And that implies that over time, bond yields are going to be higher, both because nominal, it have to be higher because of higher inflation, and real rates are going to be higher. That's why in my ETF, we stay away from long duration bonds, because in a 60-40 portfolio, long duration bonds are the defensive asset when inflation is low and stable, and therefore the correlation between bond and equity prices is negative. But in a world where gradually over time inflation is higher and bond yields are higher, you lose money on the bond side of your portfolio, the 40, but with higher bond yields also you can have a correction of equities like it happened in 2022 and happened also again in the summer of 23. So over the medium term, this is not a short-term kind of forecast. If we follow policies that are stagflationary, a 60-40 portfolio is going to do poorly, and you have to find something that is an alternative to the traditional defensive asset. It's not going to provide you a hedge when inflation is higher, real yields are higher, and bond yields are higher, and the price is lower. That's why we suggest short-term treasury, tips, gold, ag commodities, and environmentally sustainable types of real estate for this world in which gradually over time, inflation might be higher, there could be de-dollarization, there could be geopolitical risk, there could be debasement of fiat currencies.
When you mentioned last time in our interview those kind of spokes of the risk wheel, I called that the Nouriel portfolio. So I'm glad that you've put it into use here with the fund. It seems like somebody who has an acute vision like this for folks now who want to get exposure to it directly, they can. So let's talk about it. USAF Atlas America Fund. It's an active ETF. Trades at 75 basis point expense ratio. I think probably the most interesting way to get into this is along that point about bonds, where it seems you want to present this as sort of a defense asset, an alternative to the long-term treasury. But the first thing someone will notice is that there's a lot of treasury exposure in here, but on the short end. So tell me about that, Nouriel.
Yes, the whole point is that traditionally the defensive asset is long duration treasuries, because there is a negative correlation between bond prices and equity prices. Risk on and growth, equity do well, bond yields are higher, price is lower, you make money on the equity side, you lose money on the bonds. Risk off recession, equity go down, bond yields go lower, the price goes higher, you lose money on equity, but you make money on the bond side. But that negative correlation holds only if inflation is low and stable. If instead gradually inflation goes higher, then bond yields are higher and you lose money on the bond side of your 60-40, but higher nominal and real interest, it implies, like we've seen in 22, 23, that also there is a correction in equity prices. So the point is, in a world where over time inflation is going to be higher, the traditional defensive asset is long duration treasury doesn't work anymore. And that's therefore our ETF is an alternative to the 40 part of your 60-40 portfolio by having something like short-term bonds, like tips, like gold, like ag commodities, and sustainable real estate. They're going to do well in states of the world where inflation is rising, there is de-dollarization, there's debasement of fiat currency, there is geopolitical risk and other risk of that sort. So it's an alternative to the long duration fixed income in the 60-40 portfolio.
The biggest holding right now is in iShares Gold Trust, is at 9%. Just looking at the latest data here. So there's a big gold position in there. I'm curious on that short versus long-term yield, though, Nouriel. Is there an implication here in the fund that while inflation will stick around, the Fed won't be able to hike to combat it? Because in 2022, when we were hiking, those short-term rates got hit too. You would have been you would have been in pain too as the Fed was having to hike on the short end of the bond portfolio.
Well, part of the story we're saying is in a world in which there is too much private and public debt, if the Fed were to react to a sharp increase in inflation by tightening, eventually you're going to have a debt crisis because we're in a debt trap, and you're going to have also a recession, and that ratio become larger and larger. So the Fed is going to be constraining its ability. Long rates are going to be going higher. So you're going to lose money on the long end of the yield curve. But on the short end of the yield curve, first of all, our tips are duration adjusted. So they're going to do well when inflation is higher. And if you hold very short-term treasury bonds, those have a higher yield and the price impact is very small compared to the one of long duration fixed income. So you tend to do well with very short duration treasury and tips in a world where inflation is going higher, regardless of what the Fed does.
So the income part seems like the focus then, fair to say?
Yeah. Yes.
Okay.
Yes.
So you've got the income side to it. How about the gold position? Do you view that as sort of a kicker, a bonus for sort of principal accretion for the price of gold? How does that fit into the thesis? What environments do you think work best? Because it sounds like for bonds, what you're describing basically is a steepener of sorts, where the short end remains contained, long yield's going to be a bit of an issue. How would gold fare in that type of environment?
Well, historically, gold has done well in periods of time where inflation is higher where there is a risk of debasement of fiat currency, when there is geopolitical risk and people want to go into safety of gold, but also in periods of time where there's potential for de-dollarization. If you think about it, the strategic rivals of the US, Russia, China, North Korea, Iran, but also some of the frenemies of the US, if they're worried about us seizing their foreign reserves of dollar, euro, yen, or whatever, what is the only foreign reserve asset that is liquid that cannot be seized by the US, Europe, or otherwise? It's gold bullion. And that's why actually we have seen in the last year a significant increase by a number of central banks in their demand for gold, trying to diversify away from dollar and other assets can be seized. And gold has gone up by about 40%. So the story about gold is a combination of factors, including geopolitical fragmentation leading gradually over time to a process of de-dollarization and our enemies trying to diversify away from dollar and euros into gold.
I will say gold has been quite impressive in many different environments, to the point of kind of the gold bug argument over the last 4 years. So we've had so many different macro environments: positive surprise, negative surprise, inflation, disinflation, and gold has just continued to grind. How about, though, Bitcoin and crypto, Nouriel? I mean, it seems like if you've got a portfolio that's basically geared towards defense, there's a shared narrative, which I'm as big of a skeptic as you are in terms of the veracity of the Bitcoin narrative. But why not even drop a little bit in there in case their defense argument also rings true for a different generation like gold? And then if it even doesn't make sense, maybe it just goes up a bunch and you get a little wild card kicker.
Well, I've been skeptical of Bitcoin and cryptocurrencies for a number of reasons. The most important thing is that we want a defensive asset that has good, high single-digit returns with very low volatility. And this particular combination of assets has shown to have those features. If you introduce something that literally overnight can go up by 10% and overnight falling by 15%, you are creating a huge amount of volatility. So if you want to be in a part of your portfolio that is truly defensive, the wide range of combination of assets we're including essentially gives you positive return. There is convexity because when inflation is going to be higher, the returns are even higher, and the volatility is very low. So I think it's very important to keep volatility low. Okay,
it's kind of similar to the point about principal versus income on bonds, volatility and subdued volatility being the goal here rather than potential upside return necessarily, because you're going to be living up to your expectation if you can hit high single digits, basically. Nouriel, what about potential correlation risk for markets overall with $100 billion in Bitcoin ETFs? I personally feel that the game is not over yet. There's a long-term bearish divergence in the chart of Bitcoin, but I mean, there's a lot of money in here now. Do you think there is potential risk if you think this is still, a nothing asset?
This asset class is still not large enough for it to essentially have systemic effects if there is a correction. But of course, if the links between the traditional financial system and the crypto one were to becoming stronger, if leverage in these types of investment were to be financed by the traditional financial system, then if a significant correction were to occur, and we've seen in the past crypto assets falling by 50, 60, 70, even more percent than that, then at some point there'll be a wealth effect, and you have to start to think about financial stability consideration. So far, those have not been important. If this asset class grows, those may be coming consideration to keep in mind in the future.
All right, back into the macro stuff on the more traditional side. To come back on a point with potential currency debasement and the dollar, if stagflation's a risk and that kind of really interesting steepener happens that you talked about, what do you look for in the dollar? Because it's held its own, and it seems like relative to the rest of the world, the U.S. just keeps coming out on top economically. Is there anything that could weaken the dollar here? I mean, it seems like these arguments you're making would be for lower dollar, but the thing just doesn't break. So what could break it?
Well, several things could break the dollar. First of all, if we end up in a world in which inflation becomes higher and there is a debt trap and the Fed cannot fight it, then over time that will weaken the dollar. Secondly, we are running very large twin fiscal and current account deficits. They're going to continue over time. And historically, when those deficits become very large, the dollar starts to weaken. Three, Trump has said, makes signals that he thinks that the strong dollar has led to loss of competitiveness, large trade deficits, and there are some ideas in the Trump camp of maybe even arranging for the coordinated depreciation of the dollar that is overvalued while other currency are depreciated. And we're running very, very large fiscal deficit. Of course, we're the global reserve currency, we can run them for longer. But if we don't rein in these fiscal deficits, eventually bond yields could go higher. People could get nervous about our ability to financing them. And that could, over time, weaken the US dollar.
I mean, it seems fine in theory for sure. Just to the point at the beginning that we have had this massive run up in the debt ratios and dollar's been hanging in there. Is that just telling us that the rest of the world is even under deeper pressure? Because that kind of comes back to like the MMT point, which is as long as we stay on top, we can print whatever we want, as long as it's not like actively negative for the economy.
No, so far the dollar is strong, and the dollar for the time being between tariffs and fiscal deficits might stay higher. My point is that large fiscal and current account deficit eventually, historically, lead to a weakening of the dollar. It's not going to happen in the short run, but these twin deficits are not sustainable. And if you add to it the fact that there is a large supply of public debt, the Fed is now doing QT rather than QE. So the demand from the Fed is not coming there. And you have that the foreign central banks are worried about sanctions and they're buying less of our bonds. Then over time, the supply remains large and the demand is not going to be as strong. And that can lead either to a significant increase in bond yields and or a combination of that and a gradual weakening of the dollar over time. So geopolitical risk implied that gradually over time there is de-dollarization. That could be a source of downward pressure on the dollar over time.
It seems like the interest of foreign buyers of treasuries is going to be a very important part, as well as pension funds too, because I think that right now is kind of the strongest pillar of that argument, frankly, as we have seen some of those numbers taper off a bit. Nouriel, what about this DOGE thing? Is there a potential positive then? If we go like inverse doom, if we go like sunshines and rainbows, let's say they cut all the people who didn't need jobs to begin with, lowers the cost of running the government by transition, reduces the expenses, deficit, et cetera. Is there a possible outcome then that's positive for the economy if they make these right layoffs that could lessen some of that deficit concern?
They could, but let's put it this way. Realistically, I don't think we can cut government spending by $2 trillion. Most of this government spending is entitlement from Social Security, Medicare, Medicaid, that Trump doesn't want to touch, interest on the debt we cannot touch, defense spending that most likely there is not too much to touch. So discretionary spending is limited. And if you look at the list of the promises that Trump has made, between making permanent his tax cut of 27 to no taxes on tips, no taxes on overtime, no taxes on Social Security, no taxes on the income of US residing abroad. The estimate is that these are going to cost us over the next decade about $8 trillion of additional debt. So is there fat in government spending? Absolutely. Can DOGE cut that spending? Absolutely. Is that we should do that? Absolutely so. But I don't think that DOGE alone is going to deal with our very large fiscal deficit unless we start to talk about touching entitlements, something that historically has been the third rail of US politics. So eventually we'll have to do it because the trust fund of Social Security is going to run out of money sometime at the beginning of the next decade. But probably that political debate is going to occur 4 to 6 years from now, not right now.
Okay, very interesting response. And some irony in that that's the second time I've heard you use the phrase DOGE. In this case, some credible, that's actually what it's called. All right, Nouriel, one more here, which is the potential for deportation to affect the workforce in a negative way and inflation in a negative way. Connected to the DOGE thing, what if we send people, back, but then there's a bunch of people looking for jobs who just got laid off by the government? Does that ease the blow at all?
First of all, I don't know whether we're going to really be able to fire that many, public employees. They have some rights. It's going to take time, and I don't think there'll be massive reduction of the payroll. There'll be some, but it's not going to be massive. And the reality has been that while, of course, immigration is not politically popular, and one of the reasons why Trump won was because of his anti-migrant policy, one of the reasons why growth has been stronger in the last 2 years and inflation has fallen is that between documented and undocumented workers, we have had about 2.5 million people entering the United States per year, something like 10 million people over the last 4 years. And we need these people because the unemployment rate is very low. There are plenty of jobs that Americans don't want to do. The labor market is extremely tight. And actually, we need migration. I'm all in favor of documented as opposed to undocumented workers. Maybe we have to change our own migration system to a reform like the one of Canada or Australia, where we're looking for the people with the right skills, human capital, education. But the reality is that the US needs at least 1 million, if not more, net migrants every year. And therefore, if we were, and it's a if, to go to mass deportation, I would say that that's going to be having a negative impact on economic growth, and it would increase everything else, equal wage and inflation overall.
Understood. Dr. Roubini, thank you very much for your time. Pleasure talking with you. Appreciate the deep dive into the economy and policy. Great stuff.
Great being with you today. Great pleasure.
Thank you very much. Dr. Nouriel Roubini, NYU Stern Professor Emeritus, CEO of Roubini Macro Associates, Chief Economist at Atlas Capital Team. USAF is the fund. Make sure to watch every episode of Market Overtime on schwabnetwork.com and on the Schwab Network YouTube page. Go and subscribe. Thanks for tuning in. See you next time.